If you're getting ready for the NMLS Safe Exam, you know that advertising rules are a pretty big deal. So in this session, we're going to break down exactly what you need to know from the Truth in Lending Act and Regulation Z. The goal? To make sure every single ad you create is totally compliant. So think about it for a second. The last mortgage ad you saw, maybe online or in your mailbox, could you tell for sure if it was playing by the rules? Knowing the difference isn't just about passing your exam. It's, a huge part of being a professional and ethical MLO. All right, here's our game plan for today. We're going to start with the core concepts, the real basics. Then we'll cover the 4 absolute don'ts of advertising. After that, we'll get into the super important trigger terms, touch on some special rules for dwelling ads, and wrap up with a look at what happens when you don't comply. It's not pretty. Okay. First things first, before we can really dive into all the specific rules, we've got to speak the language, right? So these next few definitions, they're the absolute foundation for everything else we're going to talk about. So let's start at the top. The entire world of credit advertising is governed by the Truth in Lending Act, or TILA. And TILA is implemented by what we call Regulation Z. This is the legal framework. You have to operate within these lines always. Now let's talk about the APR. This one's a favorite on the exam, for sure. You've got to remember, the annual percentage rate is the true cost of borrowing. It's not just the interest rate. It bundles in most of the loan's costs. We're talking fees, points, the whole deal. That's why the APR is usually a bit higher than the note rate, and it's absolutely the key to comparing different loan offers apples to apples. And right alongside the APR is the finance charge. Think of them like siblings. While the APR shows the cost as a percentage, the finance charge shows that exact same cost, but as a total dollar amount. It's the grand total of everything the consumer pays to get that credit, like origination fees, points, and mortgage insurance. Okay, this is another really crucial distinction you've got to know. The amount financed is not the same thing as the loan amount. Nope. It's the loan amount minus any of those finance charges that get paid right up front. So, in other words, it's the actual net amount of cash the borrower really gets to use. Let's make this super clear with an example. Say a borrower gets a $200,000 loan, but they have $7,000 in prepaid finance charges. Well, the actual amount financed is only $193,000. It's a really simple calculation, but it's so important for making sure disclosures are accurate. So now that we've got the lingo down, let's get into the absolute non-negotiable rules. I like to think of these as the 4 commandments of compliant advertising. You just don't break them. All right, here they are, the big 4. Number 1, an ad cannot be false or misleading. That's really the golden rule of everything. Number 2, all those required disclosures, they have to be clear and conspicuous. You can't just bury them in tiny print. Number 3, you can only advertise terms that you can actually offer. And finally, bait and switch, absolutely forbidden. You can't lure a customer in with some amazing deal that magically disappears the second they walk in the door. Okay, this next section, I'd argue it's the most important and definitely the most tested part of TILA's advertising rules. We're talking about trigger terms. Think of them as magic words. Once you say one, you're required to reveal a whole lot more information. It's really that simple. If your ad uses a specific number or term, a trigger term, it automatically, triggers the requirement for you to provide a bunch of other key disclosures. You can't just say the trigger term all by itself. You've got to give the full picture. Now, it's really important to know that the rules aren't the same for every type of loan. We have 2 different sets of trigger terms and disclosures. There's one for closed-end loans, like your standard 30-year fixed mortgage, and a whole other set for open-end loans, like a home equity line of credit or a HELOC. So for closed-end loans, these are your triggers. If you mention the down payment, like 5% down, or the loan term, like a 30-year loan, or a specific payment amount, or the finance charge, boom, you've set off the trigger. Fun fact, though, saying something like 0 down or 100% financing is actually not a trigger term because you're not stating a required down payment. So, if you use any of those trigger terms we just looked at, you are now legally on the hook to clearly and conspicuously state these 3 things: the down payment, the full terms of repayment, and, you guessed it, the annual percentage rate, or APR. And here is a perfect by-the-book example of a compliant ad. See how it mentioned $5,000 down? That's a trigger term. So because of that, it was then required to include the repayment terms, that's the 360 payments part, and the 10.5% APR. This ad, It checks all the boxes. Beautiful. Okay, let's switch gears to open-end loans, like HELOCs. The triggers here are a bit different. They include things like mentioning any finance charge, specific other charges like appraisal fee waived, any taxes on the deal, or the payment terms of the plan. And if you hit one of those open-end triggers, you've then got to disclose this whole set of info. Any loan fees, the cost to open the plan, the periodic rate used, and, this is a big one for variable rate plans, the maximum possible APR. Now, on top of all the trigger term stuff, there's another layer of rules. These ones apply specifically to advertisements for credit that's secured by a dwelling, and they're really designed to stop some very specific misleading things aimed at homeowners. You absolutely have to know these for the exam. For example, you can't use the word fixed when you're talking about an adjustable rate loan. You can't say a loan is a government program unless it actually is one, like an FHA or VA loan. You also can't use a consumer's current lender's name to try and trick them. And you definitely can't call yourself a counselor. Oh, and making crazy claims about eliminating all their debt, that's a huge no-no. So we've gone over the definition and the rules. But why is this all so critical? Well, this last part connects everything directly back to the SAF Act and shows you the really serious, career-changing consequences of getting this stuff wrong. And here it is, the number you need to remember, $25,000. That's the maximum civil penalty. But get this, it's not per ad campaign, it's per single act or omission. One bad ad could easily rack up multiple violations and some truly staggering fines. And honestly, the fine is just the beginning. State regulators have some serious power. They can deny, suspend, or even completely revoke your license. They can order you to pay restitution to consumers you've harmed, and they can hit you with immediate cease and desist orders. This isn't just a slap on the wrist. We're talking about protecting your entire career here. Wow, we've covered a ton of ground, from the core concepts all the way to the high stakes of getting it wrong. The goal isn't just to memorize these rules, but to really get the why behind them. So the next time a mortgage ad pops up on your screen, just take a second. Look at it. Do you see any trigger terms? Are the disclosures there? Honestly, learning to think like a regulator is the absolute best way to master this stuff.